So if you see a year next to your retirement funds, what does that actually mean? Well, it means you're in a target date fund. And a target date fund is an algorithm that gradually gets you more and more conservative as you approach whatever that date is on your fund. So when you first set it up, maybe your manager or HR or financial advisor said, okay, well, you're 30, you plan on retiring at 60, so we're gonna do a 2050 fund or whatever it is. But is that the best way to go? Let's explain how these algorithms work and why they're good and why they're bad. The beautiful thing about target date funds is they're usually pretty low cost. So, there's not a lot of management there, and they gradually just put you over, based on an algorithm, more and more into bonds. And by the way, if you don't know the way bonds work or how they're affected by interest rates, we put both of the links below to our past videos. But target date funds just basically gradually buy more bonds and sell more equities. If that's what you want and you want it to be low cost, it might not be a bad option for you. The bad part about a target date fund is it's an algorithm. They're not taking into consideration current market conditions, whether or not interest rates are rising, whether or not bonds are falling. So if you don't just want to blindly buy more bonds and sell off your equities, maybe it's not the best way to go. So here are the 3 things you need to think about before you buy a target date fund. Number 1, do you want every year to sell some of your equities that you own, the stocks, the companies that you own, and buy more into bonds? If you don't, then a target date fund is probably not for you. Number 2, do you want active management from an actual person? Some people like the idea of someone else managing their money and looking at current market conditions and making sure that their money is doing what they want. Other people are okay with an algorithm, but if you say, listen, a computer algorithm isn't enough for my livelihood, I want an actual professional to manage my money, then once again, that might be something to think about before buying a target date fund. And the last one is, what's the actual return and expense ratio for that fund? We said that they're typically low fees, but some can actually be a little bit higher in fees as well. So you want to look at what you're paying for that algorithm, and you also want to make sure that the returns are okay and they're high enough for what you want. Because not all target dates are created equal. They still buy different equities and different bonds that perform differently. So you want to make sure that, you say, okay, I'm okay with having an algorithm. I'm okay with gradually going more into bonds, but are you okay with the actual returns and the fees on the ones available in your retirement account?